Why is Canadian rental income taxable regardless of the landlord's country of residence? Many non-residents who own property in Canada find themselves puzzled when they receive notices from the CRA demanding taxes on rental income, especially when they live thousands of miles away. If you don't live in Canada, why should you pay tax on money earned from your own investment? The answer lies in a principle that's common in global tax systems: source-based taxation. Taxation based on source, not residency. Canada follows a global standard called source-based taxation. That means income is taxed where it is earned, not necessarily where the person lives. If you own property in Canada and that property generates rental income, whether short-term or long-term, then the CRA considers that income Canadian source income and it's fully taxable under Canadian law. Your residency doesn't change the location of the income source, and in Canada, rental income earned from real estate located within its borders is always considered Canadian source income. You're using Canadian infrastructure to earn. Another way to understand this: even though you're abroad, your rental income comes from a property that benefits from Canadian public services: roads, law enforcement, fire protection, and legal systems. These services make the property valuable and usable for tenants. So from the CRA's standpoint, it's only fair that a share of the income stays in the country through taxation. The role of Section 216. Canada isn't unfair about how this tax is collected. The government offers a more flexible option to non-residents through Section 216 of the Income Tax Act. It allows you to file a return based on net income, gross income minus expenses, which can significantly reduce your tax bill compared to the flat 25% withholding on gross rent. However, this only works if you proactively file the correct forms, like NR6, and submit a Canadian tax return on time. Why non-residents get caught off guard? Most confusion comes from comparing Canada's tax system to that of other countries. Some nations tax based on residency alone, but Canada taxes both based on residency and source, and rental income falls squarely into the source-based category. Unfortunately, many foreign property owners mistakenly assume they don't owe taxes in Canada because they don't live there. The rent is deposited in a foreign account. They're already paying tax in their home country. But without filing in Canada, they may face CRA audits, withholding penalties, denial of expense claims, interest charges. What if you're paying taxes elsewhere? If you're paying tax on the same income in your home country, you may qualify for a foreign tax credit under Canada's many tax treaties. These treaties are designed to prevent double taxation and allow you to legally offset what you owe. Own rental property in Canada but live abroad, you still have CRA obligations. Call 416-283-8774 or visit theaccountingandtax.com.